Hi, it's Tuesday again, and maybe last week's message hasn't really sunk in yet, but you remember, don't freak out? Well, there's a lot of reasons why maybe you should freak out. And again, last week I talked about people that are still far away from the market or needing their money to live on retirement, and they've got a long ways to use it. And if that's the case, don't freak out. These corrections, these even recessions are actually a good thing for the market. They need to go back to actual values. I know we had a big sell-off starting the week this week, and people freaked out. The market shut down, and oil's down crazy over the weekend. Futures are down crazy over the weekend. They're still scared about the coronavirus. There's a lot of things to make the market scared. There's a lot of things that may be irrational and may be considered oversold. Now, that doesn't mean you're not seeing your portfolio drop. Maybe your 401k looks more like a 201k or getting close to that. And we know the market can correct very, very steeply and harshly. And within a matter of a few months, you could see those values of those portfolios going down quite a bit. If you are not needing that money for 5 or 10 years, you should not freak out. And that was the message last week. If you need that money to live on, and if that money going down makes you sick because you think you might need to get at it for some reason, that means if you have to sell in a down market or in a bear market, you may be locking in a loss. And that's really the only way that's bad to play the market, is sell at a loss, right? Sell when it's down. If that's the case, you need to rethink your investment strategy. You need to reduce your risk. Maybe you took too much risk. Maybe you didn't really make a plan for this contingency. It's like almost like we're on a drug high when the market's going up and we see our portfolios growing. But when the market falls like it has been lately, it feels like we just had a death of a loved one in our family. I mean, that's the same kind of chemical reaction that's going on in our brain. And so the emotions are running very high. Sometimes those emotions can make us do irrational things, like buy too much when the market's good. The euphoria gets us in trouble. And then maybe sell too early when the market goes down. So keep in mind your time horizon, keep in mind the perspective, and keep in mind your plan. If you don't have a plan, that might be why you're freaking out. So get a plan, work with an advisor who's good at planning for retirement. If you don't have one, come see us. We'd be happy to help. Figure out what your risk tolerance ought to be, how long your time horizon is before you will need that money. Look at market cycles, look at market histories, look at market evaluations, or market valuations rather, and figure out how much risk you need. Now, if you're already getting closer to retirement and you're kind of thinking, man, I really can't afford to lose what I've saved my whole life for, then you need to reduce your risk. And there are options that I've talked about several times on where to move that money to. If the market's down, and you think it might continue to go down, you want to go off to cash or some defensive place anyway, right? If the market's down but goes up, you don't want to miss the up. And that's why we're stifled. That's why people get so frustrated and confused at times like this. The cool thing about indexed annuities or indexed life insurance products, insurance companies manage risk. They protect your principal. If you get out now, even while the market's down, you go in at a low point when it comes to the indexes that you're playing. If the market goes up, you're going to make that money back over time on the upswings. If the market continues to go down, you're no longer going to be losing principal. So if you want principal protected accounts, or if you're thinking, well, I don't know if the market's going up or down, but I don't want to be hurt or stung worse than it feels like I already am, then move some of that money off the table. Put it in indexed accounts that can no longer go down. Principal protection gives you peace of mind. It gives you stability. It also gives you a place where you can go and get money out of that investment without ever locking in a loss, because there's portions of those indexed annuities or life insurance type products that actually allow you to tap into the balance, sometimes even on a tax-free basis, so that you can use money when you need it, but never lock in a loss unless you blow out or surrender the policy. And even then, it's not as bad as a bad stock market crash. So if you haven't thought about diversifying out of the Wall Street highs and lows and the Wall Street roller coaster, think again. Insurance companies are there to protect us against all kinds of risks, including money management risk, including stock market risk, including interest rate risks, and a lot of risks that maybe we don't give insurance companies credit for. But being a comprehensive advisor like we are, we always incorporate insured asset classes as well as non-insured asset classes. If you want to swing for the fence and hit home runs, you might not be able to do that with an insured asset class, but you could hit some home runs. You could also strike out like some people are feeling like they're doing right now. So if you want a nice balance, remember, insure some of that account to give you that extra peace of mind that you need so that you don't have to freak out in times like these.